I expect the buying power of the dollar to diminish next year in the same way it did this year, the year before, for decades, if not 100 years plus. A $20 bill might buy you and two of your best friends a cup of coffee at Starbucks. It certainly won't get you a room at the plaza, a steak dinner, a new suit, a shave, and a haircut. So, what we've seen is over time, large swaths of time, gold have relatively stable buying power.
Hello and welcome back to Soar Financially. My name is Kai Hoffmann. I'm the Ed J.R. mining guy over on X and, of course, your host of this channel. And I'm looking forward to the upcoming conversation here today. It is with returning guest Gary Wagner. He's the editor over at thegoldforecast.com. Somebody I love chatting with. I love his analysis, and I don't bring him on enough. I say it every single time, but we only do 3 interviews a week, so it's like, it's tough to bring him on. I'd love to chat with him almost weekly. It's tough, but I'm so glad that he made the time to come back on for a bit of a year-end review and a bit of an outlook for 2025. We last spoke mid-August, or almost at the end of August, right before the first rate cut. He made some fantastic predictions. He predicted 3 cuts in 2024. That's absolutely happened. He called gold price almost to the T here. Resistance levels, breakout levels, phenomenal analysis. So please pay attention to exactly what he's saying, what is going to happen here in the gold price. I know I'm paying attention and listening. Before I switch over, hit that like and subscribe button. It's a free way to support this channel, and it is tremendously appreciated. Thank you so much. Now, Gary, without much further from me here, good to see you again. Thanks so much for making the time.
Great to be here again. And God, there has been a lot of activity since we spoke last. So interesting times.
Yeah, let's recap in a second here, but I got an icebreaker for you, maybe an opening question. It's a bit different than usual since we're doing a year-end review, but what was something in 2024 where you went like, oh, that's interesting? Like, I didn't expect that to happen, maybe.
Well, the most interesting and most impactful thing that we witnessed this year was a presidential election. During the presidential election, many of the polls, if not the majority of polls, said it was too close to call. And yet, when the numbers started to come in, what I was surprised at was the overwhelming win by our upcoming president-elect and his plans for the country and how that might reflect the financial markets, specifically gold and silver, the precious metals as well as the dollar. So that was the most surprising thing. In terms of budget deficits, we continue to acquire more debt. In terms of fiat currencies, our dollar has less buying power now than it did last time we spoke, and less buying power than it had the previous time we spoke. So there's an ongoing trend where when we look at the dollar, I like to look at it not in relationship to other currencies, although that's important, but I like to focus on the fact of buying power, because that's really what counts in the pocketbooks of those living in North America, is what you can obtain for a dollar. And then, of course, that's tied to wages. So the most surprising thing to me was how tight the race was predicted to be and how much of a blowout the final outcome was.
Yeah. No, absolutely. It was an interesting one, especially since the polls were so far off. And 14, 16-point swings in certain states that was really a head-scratcher. So, but maybe we'll start there, since we're reviewing 2024, and you sort of hinted at it, but the election and the results of the election, did that sort of change the chart patterns? Was that sort of a shock to the charts? And maybe we can take a look at them here together, but did that change anything to your patterns and to your formula or anything?
Well, the formula and the patterns that I had been looking at pretty much remained fairly consistent. We've just put up a chart, and what we are basically looking at, and let me take it to what I'm considering the beginning of the rally, which is the first part of October 2023. And you can see gold's trading below 2,000. What I have on the screen is a series of Elliott wave counts, 1 through 5, a correction, and then a second full impulse, or what we call a motive phase, waves 1, 2, 3, 4, 5. And obviously, At the end of October, we hit the all-time record high at 2,800, and we then entered a correction. And this correction is not the basic standard corrections that Elliott wave technicians look to unfold. Typically, we'll see what's called either a compression triangle and a thrust or breakout to the upside, all things being equal, or what we call a standard zigzag, which means we will have a wave down because it's correction from a bull count, then our B wave up that should go anywhere between 50 and 75% of the move down of A. It came in right at around 68, so filled those parameters. However, if you look at the pointer that I've got, your C wave should actually either go and equal your A wave, which would be these numbers here, right around 2,600, or below, which is called a standard zigzag. And if it's equal to this first down wave, it's basically called a flat. You can see I've labeled it much differently. I've labeled this as a double compression triangle, and that I'm labeling it as a WXY and then XZ. And so the question I need to answer for myself, as well as our viewers, is whether or not this correction is over, because it's played out in a very funny way. And that will have a lot to do with the upcoming administration and the tremendous variance between the current administration, or if the Democratic Party got into the presidential office, that would be more of a consistent flow in terms of the transfer of power to Democrat to Republican. That's going to be a little bit more extreme. So what effects could we see with this next administration? And to me, that's going to be the crux and the most important thing we see when we look at the price of gold next year.
Yeah, Gary, you mentioned in our previous conversation in August that 2520 is sort of the support or the resistance which we broke through, and now it seems to be a support level as well. Like, how important is that mark? Is it still 2520? I have to ask. I'm not a technical analyst, as you know. Are we still there at 2520? Does that need to hold?
I have major support at 2550, and it's really based on these series of tops that come in, as well as it is just below the lows that came in recently. We broke through our former level of support, and you see this red line on top of it. It's simply referencing the lows that came in today, the opening of gold, and the low from yesterday, because yesterday, while everybody expected a 0.25%, a 25 basis point rate cut by the Federal Reserve, and more importantly, Powell's comments leading up to the FOMC meeting before what we call the blackout or quiet period, which is usually a 10-day period prior to a live FOMC meeting, he had been talking about the pace at which they would normalize interest rates. Because what's important to realize is when you go back to 2020, 2021, we had tremendous inflation come into the mix. I think it peaked in around March of 2022 at over 8.5%. The Fed was very slow to act. Many analysts, including myself, believe they really missed the boat. They could have handled it differently and started to work with interest rates by raising them to bring down inflation. Of course, that tends to contract the economy. They did not. So they had been playing catch up for most of the time. The trajectory that they want to see is a trajectory that leads them to a 2% target. But with the Federal Reserve, they have a dual mandate. One is to keep prices stable. And so to them, that's a 2% level of inflation on an annual basis. And the second and critical component of their dual mandate is maximum employment. And so once they raised rates, they effectively took the level of inflation down substantially, never quite to that 2%. However, they did take it down, but by doing that, they had some cooling of the labor market. And so at first, as they raised rates, the Fed focused on getting inflation in check. That was the number one objective of the Federal Reserve. And most importantly, it was what they looked at over full employment or maximum labor. But by doing that, the economy should contract. That's the whole idea behind raising rates. It slows everything down, economically speaking, and therefore the labor market will cool. They recognized that the labor market was headed to a place they didn't want to see, and were content with the fact that although inflation wasn't at 2%, it was a couple of points away. So they shifted their focus. And what I found interesting about the last FOMC meeting of the year was the fact, while everybody expected a rate cut of 0.25%, 25 basis points, and Powell had been really transparent, talking about how they don't want to hurry in terms of rate cuts. They want to slow the pace down. I don't think people took it literally, including myself. And for the most part, we thought that that doctrine or rhetoric by Powell and other Fed members was fairly baked into current pricing of gold, as well as a 0.25% rate cut. And boy, we were wrong, because we saw a $50 plus decline in gold. And really what we've seen more than anything, and I'll pull this up if I can, is dollar strength. I've got just put up a screen with the dollar on the top and gold on the bottom. And what you can see when we look at this is there are times in which they should always run counter to each other. Simply put, if you pair gold in the United States against the dollar, you get 100% negative correlation between the price of gold and the strength or weakness in the dollar. And you can see that the dollar really took off in about September. It was below 100 on the dollar index. It broke above 108 at the time of this recording, which is a day after the Federal Reserve meeting. But at the same time, you saw gold at first continue to move up. They're moving up in tandem. And then we saw a disconnect between dollar strength and gold weakness. We didn't really get the kind of gold weakness in terms of pricing, if you look at these tops here, because the dollar continued to move higher. And that to me was unusual also.
When you look at the dollar chart, do you think the US dollar sniffed out a Trump win already at that point? It seems to be in line with what the forecasts or the betting community sort of was looking at as well. And if I look at the betting sides, they were spot on in comparison to the official forecasters. And so I'm curious, does that have anything to do? Because it is rather rare to see gold and the dollar move up in tandem. So I'm curious. I'm trying to make up an explanation here, Gary, and wonder if you have one.
The one common thread that I've seen over years in regards to the dollar and gold moving in tandem to the upside has been that they are typically occurs when you have Federal Reserve intervention or global central bank intervention. Specifically with the dollar, it tends to be our Federal Reserve's central bank. And that's because they are really working with interest rates, and that sets a lot of wheels in motion. And you can get tandem moves in gold moving higher, dollar moving higher, in times of Federal Reserve intervention. We saw that in 2008. We saw that in 2011. So that's my take on it. Those that effectively were able to call this incredible strength, when you consider that the dollar against the basket of currencies it trades against, not the buying power of the dollar, has risen from below 100 to above 108. That means that the dollar has gained 8% in the time span of a couple of months relative to the other currencies. And that's a really, really strong move in a short period of time. I wasn't bright enough to catch on to what these professionals saw that I didn't, because I was kind of looking at that through blinders, looking at what the Federal Reserve does and how that relates to gold and the dollar. In terms of the election, because it was so close, I wasn't looking what would happen here or there. And the key is we do have historical data about what the next administration might do, because we know what the next administration did a few years back. The Democratic nominee, we had really no data whatsoever on how that might transform or change the workings of the government in terms of fiscal spending, budget deficits, and things along those lines. So I think that what we saw was we had a winner that has been president. And so therefore we had some kind of a historical reference point as to what he might do. And typically what I've heard over and over again, and I happen to believe to a large extent, is if President-elect Trump says he's going to do something, we typically see him do that, follow through with that. And so for that reason, there might have actually been a relief rally that went on. We saw that in U.S. equities. We certainly saw that in the dollar as it gained strength against the euro, the Swiss franc, Japanese yen, sterling. As I said, the basket it trades against. And that's a strong move. If we go back further, we can see it go higher. And let me just adjust this. You can see that it did peak out in 2022 in September at around 114. So it's not at the highest level, but it's above these peaks here, February 2023, this one here, June of this year. And then it seems to have broken out, if you look, right around the middle of November, so just prior to the election itself, or just right after, excuse me.
No, Gary, looking at this, and we had Henrik Zeberg on the channel and at our conference recently, and he said, well, gold in this blow-off rally could run, the US dollar could run to 120 on the Dixie. Do your charts provide for that scenario as well? Do you see that? Like, what do the charts tell you? And then maybe we'll forecast into 2025 a little bit here now. But what do the charts tell? Because I'm always looking, and we'll come back to gold in a second. As you said, they're usually negatively correlated. So if the Dixie goes to 120, of course, part B of the question is what will gold do in that scenario, Gary?
Well, the first question is about the dollar. I've compressed this to a weekly. I guess I should do the same with the gold chart to kind of put them in alignment. Let's put it in alignment a little bit better. And we've seen the dollar recently. What was this, back in March of 2022, peak above 112, 112, 113. Historically speaking, these are the highest levels we've seen in the last 6 to 8 years. So the numbers that the one analyst is calling for, I don't know where he is ascertaining or deriving that conclusion. I, as a market technician, have to look at the data, look at where a particular stock or commodity or currency has been, and ascertain how likely it is that it will achieve that level again. The same with the lows. If, as you can see, once the dollar came down, it bottomed here right at around 100. Here's another bottom right above 100, and the most recent bottom is 100. And if we draw this line across, we can see where it's solidly, this is again a weekly chart, solidly above it to about 103, and then kind of meandered back down over a 2-week period to where it went back to right around 100. So we know that 100 is a critical point in the dollar. We know that these series of tops at 106, 107, technically speaking, we've got good historical data, but these tops up here that came in September of 22 is a very rare occurrence. So where do I think the dollar will go? That's going to have to do a lot with GDP, of course. It's going to have to do with policies of the next administration. And most importantly, I believe it will have to do with the fiscal debt of the United States, whether it's growing again and to what degree. And what the other countries that the currencies it's kind of based against are doing also. In other words, when we say there's dollar strength, we're saying the dollar might be stronger than the euro or the Japanese yen. And a lot of that has to do with their policies versus our policies. How much are we debasing our currency relative to what other countries are doing to debase theirs? And what I mean by debase is it having less buying power, because no longer is there a gold standard. These fiat currencies, by definition, are tied to nothing but the faith in the government that issues it. And so there's no intrinsic value to it except the trust and goodwill of that government to make good on that promise, to accept that currency and allow you to barter and make transactions.
No, Gary, Germany officially is in a recession, which is the biggest economy, obviously, in the Eurozone. So I'm not surprised that the DEUTSCHE is gaining strength, at least against the euro. Japanese yen, again, they didn't raise interest rates in Japan, so the yen is weaker. So it just makes a whole lot of sense. It all fits together. It doesn't mean necessarily that the dollar is getting stronger, because we're looking at a looming shutdown in the U.S. again, because they can't apparently agree on a budget here. So there's lots going on. A bit of a question I didn't expect to ask, Gary, and I'm not sure if you have an answer, and it's okay if you don't. Like, you gave me the idea is the Chinese renminbi. They've been talking about loosening it and pushing it lower just to stay competitive again. Is that something you look at as well? Like, just something I randomly thought of since you triggered that thought and question in my head here.
Well, it's obviously they are one of these superpowers now. When you look at Russia, United States, and China in terms of world dominance, in terms of economic growth. The Eurozone, of course, is extremely strong. But in particular, when we look at the euro, we've got all of these different countries that are working off of the euro, and whether or not that fiat currency is having a smaller amount of buying power compared to the buying power of the dollar. The thing about China that it not concerns me, but whenever I see economic numbers out of there, I wonder how accurate those numbers are. And maybe this is my own bias, because over time I've heard that those numbers are fudged or this or that, and they might or might not be, because I don't know. But that's at least what's in the mainstream media in terms of their numbers. They have been expanding at such a rapid rate for so many years. To keep that pace up, to have GDP at 5%, to have growth in the way they have had, without succumbing to some sort of economic hardships at some point, I find to be almost impossible. Is the Chinese economy important to the global economy? Absolutely. It's a huge component. The question is, how accurate are the numbers we're seeing, and are they realistic?
No, I agree. Like, I think there are a lot of unknowns, and when they talk about loosening currency policies, monetary policies, we'll I guess wait and see. Let's get back to gold. We talked U.S. dollar for 2025. Let's talk gold. Really curious what the charts tell you there. We agreed that the U.S. dollar is largely a policy and debt dependent in the U.S. But what about the gold price? Do you think it'll be able to decouple potentially from the U.S. dollar, and what does it look like?
Well, it always tends to decouple to a certain degree. In other words, when you see gold and the dollar moving higher in tandem, realize that for gold to move higher with dollar strength tells you that it first overcame that dollar strength. So when we consider that the dollar has gained 8% since September, and then we look at this chart at the let's say the second week of October was the final blast from about 2646 up to the all-time record high just above 2800. I am looking at February futures, the continuous contract, for those that are wondering why it's showing the high at 2825 when spot was just about 2802 or a little bit below. And most active futures, when it was December, was right around 28. So they don't get confused. This is a continuous contract of February gold futures. In terms of what I think, the first question we have to answer is, will gold find support after this sell-off from 2750 down to 2600? It's over $100 move, and that move occurred between the 12th of December and the current date. So right about a week, a little bit over a week, and we've seen gold really come down hard. Now, this red line represents where I am looking at technical support, and I'm basing it on this top here, and then below that, this blue line, these tops here. The key is this. As a market technician, charts tell us historical data, and we're able to extrapolate where something might go. And there's a gentleman who's world-renowned as a market technician named Larry Williams. And years ago, I went on a speaking tour with him and 10 other speakers for a Dow Jones Financial Symposium. And I remember I was kind of the green pea of the crowd. These gentlemen were much more seasoned and older. And the reason they were drawn to listening to me, because I was one of the few people looking at candlesticks. And at that time, that was very hot. And this is back in the late 90s. And Larry Williams said something to me that always stuck with me. He says, Gary, we are market technicians. We look at data, we look at charts. The analogy I want you to understand is this. We're on a large boat. We're sitting at the back of the boat. We're looking at the wake created by the propellers as they turn and trying to analyze where the boat is headed. And I said, that makes sense. He says, except for one thing. Only the captain knows when he's going to turn the wheel. So in other words, the fundamentals are what's going to drive any of these moves. There's a lag time between that and what we see in a chart. There are certain technical indicators that are what we call leading indicators. They tend to be good at predicting the future. Things that are moving average based tend to be a lagging indicator, and the larger the sample size of the average, the more it lags behind real-time data. So the question is, will gold be able to hold above 2,600 through this year into next? And then as the administrations change in January, what effect might that have on the dollar, on gold, on the financial markets as a whole? And we'll address that maybe towards the end of the this interview.
Okay, no, perfect. Let's do that then. I'm really curious. It feels like we're a bit in limbo right now. I can't change that feeling, at least like from the mining stock side. It feels like we're waiting until January 20th, maybe even January 28th, when we have another Fed meeting, to see what the trajectory for the year is going to be. Remind me a bit of Roosevelt's new plan or New Deal back in the 1930s. The second the president comes into the office, he starts issuing degrees, signs executive orders, so on, so on. So I'm curious if that will happen again. And it is a bit of a wild card out there. It's a bit of an unfair question, Gary, but where is gold going in 2025? You know, we briefly talked about it before hitting the record button. I want some numbers, Gary. What can I hang, or what can we hang our hats on here?
Well, we can address what we saw in the first Trump administration. He is highly favorable in terms of tariffs. And when you place a tariff on a goods or services that come in from another country, that raises the price to the consumer, and therefore it's inflationary. Higher inflation presents bullish undertones for gold, typically moving it higher as long as it can overcome dollar strength. So he's talked about it infinitum about renewed tariffs on China and other countries as a way to get revenue in and at the same time not raise taxes. And so if he's true to his word, and I have no reason to believe that he won't be, that could add some inflationary pressure. Inflationary pressure typically is a solid, provides a solid tailwind for gold. The second thing is budget deficits and budget spending. As you just correctly pointed out, once again, the U.S. is about to run out of money unless it funds a new bill to appropriate the needed dollars to take care of the ongoing budget. Historically speaking, America's always paid its debts. And anytime it ran into this roadblock of raising the debt ceiling, because that determines how much money the Treasury can print and thereby determines what can be paid for, in each and every occasion, I won't say each and every, in the vast majority of occasions, they did two things. First, they kicked the can down the road till the final 12th hour. They didn't make a decision until they had no choice but to make a decision. And the decision they made was to raise the ceiling in terms of how much money they would print. And what that does is it makes the dollar, in terms of the buying power, less valuable. And so that also provides bullish tailwinds for gold, because gold, the way I look at it, has remained fairly stable in terms of buying power. Again, I'm not trying to relate it against the euro or other currencies, but if you go back in time, even 100 years or so, if you had a $20 bill or a $20 gold piece, 1 ounce US minted 1 ounce gold piece, or a $20 bill issued by the government, you could do quite a lot with either of them. In fact, I think in the early 1900s, the plaza to get a suite there in New York was about $8. A suit was around $20, $25. A good steak dinner was about $1.50. So in other words, with either a 1 ounce round of gold or a $20 bill, that was the relationship between gold and the dollar for the longest period of time till really after World War II, Roosevelt, and then, of course, the Bretton Woods Act. And then the final straw was Richard Nixon taking us completely off the gold standard. Now, let's carry that forward today. I have a 1 ounce round of gold. Doesn't matter who mints it, but it's pure gold. And I have a $20 bill in the US or a comparable euro. Does that have the same buying power? The obvious answer is not even close. I mean, a $20 bill might buy you and two of your best friends a cup of coffee at Starbucks. It certainly won't get you a room at the plaza, a steak dinner, a new suit, a shave, and a haircut. So what we've seen is over time, large swaths of time, gold have relatively stable buying power. In other words, what that 1 ounce could buy, whereas the dollar has consistently lost its buying power value. I don't expect that to change because the currency isn't tied to anything in the US. There isn't any currency tied to gold. There's been talk about the Chinese wanting to have a modified gold standard. That could happen. There's also talk about BRICS. But the bottom line is, as it stands now, I expect the buying power of the dollar to diminish next year in the same way it did this year, the year before, for decades, if not 100 years plus. And the only way that that's going to change is to actually have a government that works with their financial budget in the same way you do or I do or our viewers do, which means that if we don't have the money in our coffers, we typically don't want to spend money we don't have. If we have to do that, we realize there's going to be costs of borrowing. So we take that into account, but we don't let debt grow until we would just be bankrupt. So the government has the uncanny ability to continue to print money, whether or not that's economically feasible or sound, I should say. Individuals and corporations do not have that ability. And because governments can spend more than they have, there's very little incentive for them not to do that. And until that changes, we won't balance the budget, so to speak, in the United States or anywhere else in the world, so to speak. And that means that any country that continues down that road is debasing their currency. It has a smaller buying power than it did a year, 5, 10, 20, 40 years ago, and that will continue. And I don't see any government changing. I just hit 70 in October, and that's the way I've always seen it. So that seems to be the standard and the norm. Maybe not the right thing to do, but it is how governments handle their economic and financial obligations.
Absolutely. So maybe in summary, gold is going higher, Gary.
Yeah, that's what I think. I mean, first, where's it going to stop? Where's the bleeding going to stop? Um, I think in terms of next year, I've got a basic framework that I'm looking at, and that changed after this $50 drop. I think at the low end, we should go to anywhere between 28.50 and 29. That would be a new all-time record high. At the high end, we could see gold go as high as 3,000, 3,100. I'm not one of those that call for gold to go to $5,000 or $10,000. Eventually, it probably will, but that's 20 or 50 years from now. So that's not my concern right now. But as long as government spends more than it has, and the buying power is decreased in their currency, and gold remains stable, gold only has one way to go. Not straight up or not straight down, but over time, it will have the relatively the same buying power. So I look at gold as the stability, and the currencies as something that just continually are worth less and less. Again, in terms of buying power, not relative strength to other currencies.
Yeah. No, it makes sense, and I'm with you there, and I appreciate the conservatism on the price target. I'll still use 10,000 YouTube title, of course, Gary. $10,000 a given. No, but maybe it's like we have time for one last question, Gary. And
Sure.
since we're trying to have a bit of an outlook for 2025, I'm going to ask you, make a bold statement. I'm not going to hold you to it too much, because I want to trigger something, maybe something creative. Like if you were to make a bold statement for 2025, maybe something surprising, something that, like the chance of happening is maybe slim, but it could impact markets big time or gold price big time. What is something you would say, like a bold statement here?
And you know what? You're going to think this is not so bold and fairly tepid, but geopolitical conflict, although we focus on the dollar and we have been focusing on the economy and the debasement of the US dollar, the other component is geopolitical uncertainty and the amount of conflicts in the world, because that's another thing that gold tends to hold value against. Is the crazier stuff gets, the stronger gold prices get. And so if we, by some slim chance, figure out how not to wage war against each other, that would take gold down tremendously. Do I think that probability is high? I think it's nil. If any government was able to, and the Swiss are pretty good at it because they have a different type of economic system, they tend not to spend more than they have. But if there was that transformative move by major governments to hold budgets within reasonable limits and reduce the deficit rather than raise it, that would throw a herringbone into gold, and we would see it really move lower. We will get price fluctuations throughout next year. Inevitably, I believe that gold will move higher this year. As I said, my top target is about 3,100. But that's also a moving target. That will change as the data comes in. The first thing we need to do is say, will gold find support at current levels, around 2,600 in the futures? After that, we've got $200 to go to hit the all-time record high. That will be an obvious area of resistance. 2760 will be one, 2725, and of course 2,800. So those are the stepping stones we need to see gold break through. If the new administration holds true to its word and they implement a heavy hand with tariffs, we could see inflation rear its head to a higher degree than it has. If that occurs, you could see the Fed get a lot more hawkish and less accommodative than it originally planned. Because think about this, the big thing that happened at the last FOMC meeting wasn't the 0.25% rate cut. That was widely expected and, for the most part, priced into current pricing. what wasn't priced into current pricing, even though Powell almost too overly stated that the Fed needs to have patience and pause on these rate cuts, no one gave it a lot of weight. And so when we looked at what's called the SEP, the Summary of Economic Projections, which contains the dot plots, which are the 18 voting members looking at where do they believe interest rates will be, and inflation, where will that be in 24, 25, 26, 27. We had a tremendous revamp, whereas it was anticipated that we would get to what the Fed calls a normalized interest rate, which used to be 2%. Now it's 3 to 3.5%. Now the target for next year is 3.9%. That's what moved the dollar higher, moved gold dramatically lower. If those areas get magnified, those are going to affect gold in a more profound way.
Yeah. No, I appreciate it, Gary. Thank you so much for your insights. It's always a pleasure to chat with you and to have you on the program. Obvious question, where can we follow you, Gary, for more great content?
Sure. TheGoldForecast.com. That is our primary website. Our premium members are able to view our daily videos and our reports. I do write for Kitco on a daily basis. I produce an opening letter, and we have a YouTube channel, The Gold Forecast. We are offering through the end of the year a 30% discount. Anybody goes to The Gold Forecast and decides they want to try us out. If they put Kitco in the code box, it will automatically discount our service by 30%. And that's our way of kind of rewarding our loyal subscribers as well as our loyal listeners.
Fantastic. No, let's make use of that. And we got to rename that to Soar Financially, by the way, that discount code. We don't advertise for the competition here, Gary.
I'll make sure that happens today.
All right, perfect. No, if you could send me that over, I'll happily include that in the description down below, Gary.
Sure.
This interview will air, by the way, on Sunday, and we'll make sure to share it with you and everybody else. So, Gary, thank you so much for your time. Merry Christmas, mahalo, and all the best. Can't wait to see you in 2025. Perhaps we'll see each other in Vancouver at the Vancouver Resource Conference again.
Absolutely. Merry Christmas, happy holidays to all of us, and a happy, healthy, peaceful New Year is my wish for everyone.
Oh, absolutely. That's the highest priority for 2025. Let's see if we can make that happen. Gary, thank you so much. Everybody else, Merry Christmas. Thank you so much for tuning in here to our Outlook 2025 series episode with Gary Wagner of the Gold Forecast. I tremendously enjoyed chatting with Gary, and I hope you enjoyed the conversation as well. If you did, please leave a like, leave a comment down below, and a free way to support us is by hitting that subscribe button. It helps us out tremendously, bringing phenomenal guests on the channel, and we thank you from the bottom of our hearts. Merry Christmas. All the best for 2025. We'll see each other soon. Thank you so much. Take care.